Good morning, everybody. Dan Kautz.
Good morning, Jeff Buckley.
Here we are in November.
Yes.
I say it every time with great shock and amaze that a month has gone by. I mean, I think people are sick of hearing that. But
It's going fast.
Yeah, it is. It is going fast, and we're still caught in this damn shutdown a little bit. You know,
Record
run.
shutdown level now.
But it doesn't. We're going to look at some of the slides and everything. It seems like we're doing okay in the sense of the market.
That's right.
In the sense of the market. Let's put it in perspective. So, but I guess this is my turn to forward the slides. We had a great event in October with all our clients, and it was pointed out to me by one of our clients, a dear friend of mine, that said, I guess my only job here is to forward the slides. Jeff takes care of this. I said, that's true.
That's right.
Jeff does do a lot of this work, and I can't give him enough credit for this because thank you. It takes time to do this and to get our newsletter out and running. So let me get to it here. This webinar is being recorded. It will be posted to our website. Our website is KautzBuckleyFinancial.com. You can either search one of our names too. It will pop up. Right. We can't take any live calls or texts during this recording. Contact information is dkautz@KautzBuckley.com, jbuckley@KautzBuckley.com. Office phone number 716-276-8480. The ever popular text line 716-272-1129. And we are beginning to really push some of our socials. Now our broker-dealer change is done and when everything's approved, we're back on Facebook and LinkedIn. So please follow us. And if you see this being something of value to you, don't be afraid to pass this on to a friend.
That's right, yes. I'm trying to get some good information out there.
So before we start, Jeff, last month, you made a comment. And I know some of the clients at our event said that they were expecting you to be wearing a pilgrim's hat here. So I think it's about time you darn it. Are you true to your word? I'll join you.
Where did you get these?
Oh, as soon as you said it. Make sure that buckle's in front there, John Smith.
Yeah, that's right.
I'm having a little trouble there. There you go. Get it. You got to get it on.
All right.
Yeah, there you go.
How's that look? That'll be making its rounds, I'm sure. Yes.
Look at that. The minute you said that last week, I got my wife to order these immediately. So I'll tell you what.
We'll keep those on the table
put them
there.
right here.
Yeah, so everybody knows what month it is.
There you go. And everybody, I got them to wear the hat. So I want to hear about it. Okay, let's get into the numbers, man.
All right. Well, yes. Again, as we do every month here, we'll kind of take a look in the rearview mirror and see how October treated us here. U.S. equities.
I can't believe I got you to do that.
Yeah, that was good. I appreciate it.
I'm sorry. I had to get that out. Go.
Yes, the U.S. equities hit record highs in October, led again by large cap growth stocks. We had an excellent month, the Magnificent Seven, definitely leading the pack. That's your Apple, your NVIDIA, Alphabet, Amazon, that kind of thing. And then you can see something of interest on this chart, though. We did get some breadth again. We've been talking a lot about that, where we're moving somewhat away from the Magnificent Seven, but toward the end of the month, we started to rotate back again. And you can kind of see that reflected in some of the numbers. Just for the month of October, S&P 500 was only up 2.3%, and the equal weight S&P 500. So now that's taking the S&P, all 500 of the stocks, which include the Magnificent Seven in the S&P 500, and looking at them equally weighted. And we see that the index was actually down for the month. So that does show you that we're still very top heavy in some of those very popular high growth stocks, which again, with some justification, they're bringing in all the earnings.
Yeah, the earnings have been outstanding for them. But I want to just be clear and to make sure your statement is clear. It's not that the S&P was down. The S&P was up for the month.
The full index, yes.
It's the equal weight was down. So I just want to be sure.
Yeah, because that just brings in basically the 493 other companies other than the Magnificent Seven of the 500, and it just kind of shows that overall, when you add all of them in, we actually ticked below the baseline there for the month of October.
I just want to make sure we understood that right.
But something that we're going to talk a lot about today too, though, is the seasonal headwinds have now kind of become a tailwind. And we're going to get into that a little bit more, but traditionally, historically, the month of October has not been a good month for the markets. So we were able to get through it and end the month with a pretty positive result. And now we're starting to move, and again, we're going to get into this, but we're starting to move into some of the most profitable times of the year to own stocks and including and bonds as well. So you could jump to the next slide.
May I?
Yes, you may. Pilgrim. And there's so this is just a quick look at the different sectors. And again, really just kind of what the last slide shows. Technology is still absolutely leading the way. Healthcare kind of have been in a tough spot for a lot of the year, especially shortly after the Trump election and the thoughts as to exactly how that was going to impact drug prices through Medicare, Medicaid system revisions, that kind of thing. It's been a tough area to be invested in healthcare. But on October, we finally saw things start to rebound a little bit. Financials, which had been one of our leaders kind of going into October, was one of the worst performers. So again, this kind of, I like this chart because it really kind of solidifies what Dan and I always preach. Keep that diversification. Yes, you want to have exposure to really all of these sectors because some months they're going to be the top performers, some months they might be toward the bottom, but you're going to even out your returns overall and really protect yourself too with that diversification. So in this chart, again, we explain this every month too, because it's important. What we're trying to show you here is those first two slides are really focused on the equity or the stock markets, and that really doesn't reflect what our clients truly own, because our clients do have a mix of stocks, but also bonds or fixed income investments. This is something we get off of Morningstar, and they've put together these benchmarks that really show, like the top line there is that's a portfolio that would be comprised of 80% equities or stocks and then 20% fixed income. So you can see where you may fall on this, because the bottom line there is really kind of the opposite of that, someone that's much more conservative, about a 20% allocation to equities or stocks, and then 80% allocation to fixed income. So you can still see, I mean, even year to date, even the most conservative portfolio still up almost 9%. That's a decent rate of return when you look back historically over the years into how the markets have been performing. But you can see if you were in a position where you were comfortable taking a little bit more risk and had a little bit more of an allocation of your overall portfolio to equities or stocks, you've been rewarded this year so far with pretty significant gains there, really. I mean, this is an outsized year, definitely.
Yeah, so not bad.
Yeah, not bad at all. So that it just kind of shows over. We still have the one negative sign here when you go out on a 5-year return, because we're still grabbing in that very difficult year of 2022. Yeah, when bonds, it was literally the worst year ever for bond performance that year. So when we factor that in, someone's portfolio that's overweighted to those fixed income investments,
still can't shake it.
Still can't shake it, but we're getting closer. So that's a good sign.
Hey, 6?
Yeah.
Wow, it's getting better again.
Yes. So this is our look out now the windshield a little bit here. So we're trying to look down the road, and this again is a chart that's put together by City National Rockdale, one of the money managers we work with. Dan and I just really like this because it's a quick visual look over a couple different things, different sectors, statistics, whatever it might be, but it gives you kind of an overall glimpse of where we are really in the economy as a whole. And the goal here is to try to look 6 to 9 months down the road, all right? And as you can see, I mean, we've only really got one significant move on the on the green chart here. The energy cost jumped forward a little bit, and now it's definitely in the green because oil has, with some resolution of maybe some of the conflicts, at least in the Middle East there, we're actually kind of in a position now where the oil producers are actually expecting a glut of oil on the market if everything kind of remains the same as it is right now. We still have the issue with Russia. and sanctions, potential sanctions on not only Russia, but on secondary sanctions that could be imposed by the U.S. government on countries that trade in oil with Russia. And if it goes that far, we could see a complete reversal there. We could really see oil prices spike because that would certainly limit the market overall, and that is something to watch. But right now, City National is looking at that and hoping, down the road, again, looking out that windshield, hoping that there's going to be a positive resolution.
You also notice the yield curve jumped up quite a bit too.
Yes, that's
with
right.
the interest rates being lowered over the last 2 meetings, it is beginning to smooth out and make the yield curve more normal.
Yes.
And that's very important in day and
It
time.
is. It is. We want to see that, definitely.
The bonds are the health of the market, and that's what the yield curve measures. And the overall market is the trend of our feeling of how things are going.
That's right. Yep, that's it. So we can jump on. So
November.
Here we are in November. So I thought, I'd take a look at, we're making our push now toward the end of the year, and we'll be starting a new year here in just a few months. So what is this like? Where do we stand kind of with the financial markets overall, and what factors are really impacting how probably we're going to finish this year and move into next year? I thought I'd start just focusing on November. November is here, and historically or traditionally, how you want to look at it, November is the best month on average, going all the way back to 1950 when we look at the financial markets performance. It's the second best in the last 20 years, the best the past decade, the third best in a post-election year. A lot of statistics there, but all of them very positive for how the markets generally act during the month of November. So we have that going for us. That's, I mentioned just a moment ago about we've kind of shifted from the sometimes difficult months of October and the months leading up to October. Now we've kind of shifted to those seasonal tailwinds, and usually this time of year, especially November, things look pretty good for the markets. Yep. So the next slide too, this just kind of shows you, again, we're not looking just at the month of November, but let's look in kind of 6-month increments during the year. And we've started, really just about any, pick any month there and go out 6 months, and still starting in November through April of the following year is really the average percent change is about a 7% gain. And it's about 76% of the time, it's a higher 6-month period of time. So again, those are those seasonal tailwinds. May through October is the worst 6 months for the S&P 500 historically. So again, there's the old saying, sell everything in May and go away. There is some merit to that. It's certainly not consistent every year, but there's something to be said for that. But really the opposite of that is then make sure you buy back in November and ride it for those next 6 months. So that's it. So you can jump to the next slide because it's, here, what's next? We're trying to project out for the next 6 months or so here. Seasonality is definitely on an investor's side at this point. Like I just mentioned, November and December, historically, when you combine those 2 months, very strong for equities, especially when the S&P 500 is entering November up 15% or more, and we're currently we've fallen back a little bit. At the end of October, the S&P 500 was about 17%. We're currently up about 16% year to date through the first few days of November. But still, we meet that. So again, those seasonality tailwinds are certainly becoming evident, hopefully. Resilient earnings, too. We're really in an earnings
bonanza
season. Yeah,
it's unbelievable, these
right.
earnings.
Company earnings are they're beating estimations, and then they're also they're projecting out increased growth into through the end of this quarter that we're in currently and into next year too. So nearly 87% of the S&P 500 companies have beaten their earnings expectations. Now, this data is a little dated because we get earnings reports this time of year. We're getting them out every day. Right. But at least through October 29th, that number was almost 87%, which is one of the strongest showings in years. So we do have that going for us, too. Sentiment is still skeptical. Sentiment, when we poll consumers, all of us out there, how do we feel about our overall bank accounts? How do we feel about the economy? That kind of thing. And surveys that continue to show that there's some people right now that are a little more pessimistic. However, they're still confident that things down the road it's moving in the direction where people's confidence is certainly growing.
In the chart, the speedometers really showed that, because it showed that the sentiment is in yellow.
Yes.
But it was better if we remember last time we did this in last month when we did this. That was a pretty big jump. The sentiment was a jump. And consumer spending is still strong.
Right.
It's still staying. It hasn't shown a pullback
Right.
yet. So what are they telling us, and what's actually happening?
Yes, that's really what it comes down to. The consumers are saying that they're a little nervous, they're pulling back, but yet they're still opening their wallets. Yes, exactly. So inflation, it's cooling, it's sticky, all right? It's persisting a little bit. Core CPI rose just get those pilgrim hats out of the way.
I'll save them for next year for you, okay?
Thank you. Just 0.23% in September. So we're at about a 2.8% annualized rate right now, and that is progress. Even as service sector prices remain pretty firm, and our economy is dominated by the service sector. So overall, that's positive as well. So, yes. A couple more points here. Again, going into these last couple months of this year and approaching 2026, the Fed has turned dovish. Rate cuts are expected to continue into 2026. Now, we've had two. We had the one in October and one in earlier. So right now, where we stand is, they're potentially bringing their policy down to around 3%, and that's historically, that's been a very supportive factor for the overall financial markets when we get those rates coming down and just being in a rate cutting cycle from the Federal Reserve. So that's good. Easing trade tensions. We didn't get a lot of definitive resolution on quite frankly, on much of anything, but I think the markets perceive the fact that at least the United States and China are still talking.
Right, that was pretty big. Well, they had a China framework was put out but it's only for 1 year.
Yes, that's the thing. There's limitations and everything. We still have a lot of work to do on our trade negotiations with China, and there's many, many sticky issues there. But at least everybody seems to still be coming to the table to communicate. And Trump, during his tour of Southeast Asia, there was also able to get closer to finalizing. Again, I think we're looking for some actual signed documents, but the frameworks were more complete, I think, for about 4 or 5 Southeast Asian nations too. Yep. So again, there's been overall progress made in the world economic trade framework, and hopefully the two biggest players, China and the United States, keep talking and can get closer to working something out there. Market breadth, again, we've mentioned this. There was a little bit of a change, toward the end of October into the first few days here of November. But market breadth, the equal weight indices across the S&P 500, Dow, and the NASDAQ, again, these are all stock markets, but this is what we're focused on with the growth here, recently have hit all-time highs, showing strength beyond the mega cap tech. So we're getting beyond that magnificent 7 and expanding that growth. Again, remember we saw in that earlier slide, still up about almost 9% this year to date.
Yeah,
so that's good.
It's difficult to feel good about the market in the environment of the closing down of the government.
That's true.
But we're here to talk about money. We're here to manage the money, and things are going well, and we don't see too many cracks in the dam. I mean, we're okay. So what's your favorite saying? Stay invested in the market?
Well, no, it's time in the market, not timing the market.
I felt like Tommy Boy. Say it one more time. Time in the market.
Time in the market, not timing the market.
That's correct.
Yes.
And then the other thing, too, is we just keep following the data, keep following the numbers. Try not to get emotional about this. It's very important. We haven't had too many phone calls from clients that have been asking to do big moves in the portfolio. Actually, we're still getting calls for buying second houses. We're still getting calls for weddings. We're still getting calls for vacations. I mean, people are still spending money.
They are, definitely. And I mean, the couple last points, and I think this kind of brings that home, really what Dan said. I'm going to jump to the second one first here, because now there's a little bit of a dispute out there amongst financial professionals as to whether or not this would have a significant impact on the overall performance of the financial markets or not. But it's not in dispute that currently It's estimated to have, we've got about 7.6 trillion dollars out there just in money market funds. And the thought is that as the Federal Reserve continues to cut rates, as overall rates come down, people are going to no longer be able to access just a money market account and get into a 3.75, 4%. Yeah. So as those rates come down, the thought is that at least some of this money is going to look for riskier assets, maybe not jumping right into the stock market, or even if you do, you're going into more dividend-paying stocks as opposed to the high-growth stocks, but probably expanding at least into other bond or fixed income offerings too. So overall, as this money starts to move in that direction, the thought is that that's going to help support the overall strength of the financial markets. So there's that, and then certainly something that I'm sure all of you have heard about. It's quite the conversation everywhere you go. Really, the AI or artificial intelligence fueled capital spending. We've got companies right now, and again, I think a key point to bring up is, there's been comparisons made to the 1990s and the tech boom. But back then, we had a lot of companies that their valuations increased significantly just because they said they were going to offer a website and be active on the internet, but they really had no revenue, and yet their valuations were still shooting to the moon. Right now, what we've got is we have companies that are generating significant amounts of revenue. Now, they're reinvesting that back into the artificial intelligence infrastructure. So that is seen, number one, is it's coming from a much more stable source, these companies generating this revenue, and they're putting it into infrastructure build-outs, which over time is certainly going to help us expand our use of artificial intelligence. So as that continues, we're probably going to see some displacement in the workforce, but we're also hopefully going to recognize some significant productivity gains as well.
I think it's not hopeful. I think you're going to see it.
Well,
you're going to also see new jobs we don't even know about.
Right, exactly. I think some kids coming out of college today may be getting into jobs in the next 3 or 4 years that don't even exist at this point, really.
That's exciting.
It's very exciting. I mean, I heard one speaker talk about comparing it back to, when I certainly remember the days when none of us had a computer on our desktops. None of us had cell phones. The thought was that as desktop computers came into being and everybody started to adopt them, that everyone was going to lose their jobs because there was no longer a need for a receptionist or a stenographer or somebody, a document preparation specialist or something. Whereas really, all it's done is increased everybody's productivity. So I try to be a cup half full on this. I'm very positive on this, and I think the productivity gains will be significant. I'm certainly not saying there won't be any pain while we get there, but I've got, I have kids coming out of college myself. I know it's going to be difficult on them, but it's also exciting to see hopefully where we're all going to be 3, 5, 10 years down the road.
I fully agree. Yeah. It is tough, though, to look past some of the angst.
It is.
So,
yes.
But hey, Jeff, thanks for putting this together.
Yeah.
You did a great job. And I'm always a quiet one here because I can definitely hijack a meeting. I think we've all seen that. But I want to point out again, we're back on Facebook and LinkedIn. So please, if you find any of this helpful or good information, pass it on to a friend. Let them know we're out here and we're ready to take on some referrals there, right?
Sure, definitely.
So I want to wish everybody a happy Thanksgiving, and I'm gonna tell you, wait till next month. Wait till next month. We'll see what's gonna happen.
Oh boy.
Yeah, it's gonna be great. Listen, gobble gobble. We'll see you later.
Thank you.
Bye bye.